Hey gang, let's take a look at Netflix. The stock is down 4.3% today, down about 32% in the past 6 months. But if you look at 1 year out, it's only down about 4% as well. Their Q4 earnings are out and they're actually pretty decent, although I think the market is worried about their future growth potential and whether or not this is becoming a more mature company that deserves some sort of re-rating in terms of their multiple. And more importantly, I have Netflix to thank for the nice return I got on WBD, along with Paramount, I guess. If you followed this channel for a while, you know I was a big fan of the WBD stock. And now that I'm out of this position, it's worth taking a look at Netflix to see if it's another media position that I want to start. And media is all about content. Netflix is about quantity over quality sometimes. So let me know in a comment down below what your favorite TV show is right now. Is it on Netflix or is it on one of their competitors? Netflix is the dominant player right now. That's not changing anytime soon, if ever. I think they've won the streaming wars. That's why they get the higher multiple. That's why they get the market cap that they have. However, I do worry about this WBD integration, what that means for their margins, how much debt they have to raise, and how the integration of these two separate systems will work and how long that will take. And as we look at the earnings, they're actually really good. For the year, up 16%. In Q4, increased revenue by 18%, margins improving by almost 300 basis points. Ad revenue on the ad-supported tier up 2.5x to over 1.5 billion, and they expect that to double in the next year as well. That's on top of the smaller subscription fee that they charge for that. And memberships crossed the 325 million paid threshold, which is pretty impressive. If you think about their revenue increase for the year, it's a combination of that growth in membership, which is about 8% growth from the 300 million they announced in Q4 of 24, plus the price increases that they instituted in January 2025, which was something like 8 to 17%, depending on the tier you're subscribed to. And I do wonder if they're planning to raise prices again. Their guidance for 2026 certainly won't be reached with just membership growth alone. They're adding about 25 million members in 2025 versus about 40 million members in 2024. So membership growth is slowing. And a lot of that growth is likely coming from some of the LATAM or Asian Pacific markets, which are a lower revenue per user as well. And one thing that concerns me a little bit here is that while they say that engagement remains healthy, view hours only grew by about 2% year over year, and a lot of that was driven by a 9% bump in originals, and that includes big shows of theirs like Squid Games, Stranger Things, and Wednesday, and they won't have those massive hit shows in 2026, so it seems like the engagement hours per user are probably slowing a little bit, which is not a good sign, because the idea of the service is to keep eyeballs on the service as much as possible. And that's always a fear for Netflix and businesses like it as younger people kind of age into the bracket where they would start subscribing to Netflix on their own. Are they going to do that, or are they so accustomed to YouTube and all of these TikTok short form content type things that they're going to be more attached to that sort of stuff, and Netflix's growth is going to be harder to come by in the future? So those worries are always there. There's the worries about the acquisition of WBD, which I'll talk about in a second. And then there's also guidance for 2026. I think it came in a bit lighter than people expected. They're giving guidance of about 12 to 14% year over year. Ad revenue expected to double and an operating margin of 31.5%. The revenue growth is kind of in line with what people expected. The operating margins are maybe about 100 basis points short. There's some integration of the acquisition expenses in there, or maybe 50 basis points of that, but you're still missing another 50 basis points. Some of that is coming from a more than expected increase on content spend, about 10% higher than this year, and things like that. But that's worrying investors who are kind of expecting this thing to grow at a faster clip that it's growing and maintain margin expansion in the future. And speaking of margins, I'm not worried about margins in 26. I'm more worried about margins in 27 and beyond if the WBD acquisition is to close. First of all, it has to be approved. If it doesn't, Netflix has to pay a $5.8 billion breakup fee to WBD. That's a sizable amount of money. Second, to fund this acquisition, they are stopping their share buyback program so that that free cash flow can be used towards the purchase of WBD. And it's not just the debt that kind of worries me. It's Warner Brothers itself. If you look at Netflix and their financials, because this is just a streaming business and that's it, and a mature one at that. They have amazing financials, 30% plus EBIT margins, 20% plus free cash flow margins. And then going back to Warner Brothers, this is a company that is maybe going to have $17 to $18 billion in revenue and is aiming for $3 billion in EBITDA in 2026. So that's margins in the high teens. Probably means your EBIT margins are in the mid to low teens. Probably means that your free cash flow is in the low teens to high single digits, which if you're combining that with a company that's got margins in the 30% range, you're lowering the margins of the overall entity. So as I look at Netflix in 27, yes, their revenue is going to be 17 to 20 billion higher, but their overall margin profile with the combination of additional debt, with the combination of lower margins from streaming and studios from Warner Brothers, this could be an EBIT company, an operating margin company that's in the 25% range versus the 34% range that they're expecting for the individual standalone Netflix company. And that's a big difference. And now I'm not saying that the acquisition is bad, because I think long term it's going to work out, but it's going to take a while for that new addition to start to make sense, because Warner Brothers, their streaming business is still growing. It's still expanding. Once it rolls out to more countries and is fully worldwide, maybe has 200 million subscribers by that point, and they integrate it within Netflix's systems as maybe like a buy-up tile in the Netflix app, that's when the benefits are going to start being realized. But that's going to take quite a bit of time. It's probably not going to be in 27. It might not even be in 28. So you're going to have to wait a couple of years as an investor for that combination to start to make sense. And those integrations can be painful. You look at the history of Warner Brothers, pretty much every merger they've been in, whether it's Warner Brothers or Discovery, Time Warner, AOL, etc., has been a complete disaster. So there's a worry that the integration of these two things just won't be that great. And there's some clarity that the initial phase of the integration will not be amazing in terms of how the margin profile of this new combined company looks. And it is a bit difficult to visualize that without seeing the exact results of streaming and studios for the full year as a standalone entity. So I won't really dive into those details, but as I know more about that, I'll try to make a video about it. If you'd like, just leave a comment down below if you'd like to see that. So how do I value Netflix? Well, disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Right now, Netflix, as the market is live, is sitting at a $380 billion market cap, has about $7 billion in net debt. That doesn't include some of those bridge loans that they might have taken on to fund the Warner Brothers acquisition, a $388 billion enterprise value, a free cash flow yield of about 2.5%, and a forward free cash flow yield closer to 3%. Historically, they've bought back quite a bit of stock. They do have some stock-based compensation offsetting that. As we go forward, I have some stock buybacks here with their free cash flow, but I think they're going to use a good amount of it to fund that acquisition initially in 26 and then start paying down that debt to improve their overall company margin profile. As far as growth goes, I have 13% in 26, so right in line with where they're guiding, all the way down to 8% by 2030. I'm right in line with kind of expectations from the analyst community as far as margins go. I'm maybe a bit more conservative, starting at 22% free cash flow margins in 26, all the way up to 26 in 2030. If you want to plug in your own numbers, whether it's revenue, margins, buybacks, scenarios, you can use these spreadsheets. I'll leave a link to them in the description down below. Hit file, make a copy to use them, and have fun, and let me know if you get different results than I. And again, some buybacks probably towards the latter part of this period, most of their money going towards paying down that debt. They're going to have a lot of excess free cash flow. This is a company that produces quite a lot of free cash flow, and that's going to continue even after the merger. Again, even if the margins drop post-merger, they're going to have more revenue, so free cash flow could actually be a bit higher as a combined company. Then as far as valuation goes, historically, Netflix has kind of ebbed and flowed in that 2.5% to 3.5% free cash flow yield range, depending on the year, month, and where the wind blows. Right now, I'm putting this at 3.5% as a more mature company. It could certainly be 4, could certainly be 3 or 5. Just play around with these numbers to see what you get. At that level, at a 3.5% yield in 2030, you get an expected return of about 9% from the $83 price point that it's trading at right now. If you want a 10% target return, the fair value gets to about $80. So I can see why people like this company right now. It is Netflix. It is a marquee name, great product, great brand, not going anywhere anytime soon, has pricing power, still growing on both the top line, the bottom line, and the membership. There's certainly some worries about slowing growth, but remember in 24, the guidance they gave for 25 was like 12 to 14%. They hit 16%. The guidance they're giving for 26 is 12 to 14%. I would not be surprised if they raise prices sometime soon. Just wait for the announcement in a couple of weeks. And I guess we'll see if they have the pricing power we all think they do. This revenue growth is predicated on not only prices going up, and eventually they're going to be higher. Right now, the standard plan that I pay for is I think $17.49 a month. Once it goes to like $23, I'm going to be like, ugh. That is a lot of money to pay for Netflix. Or is that just going to be the norm in the future, that I'm going to pay for Netflix no matter how much it costs and maybe cancel other services? Because right now, most people probably have Netflix and sort of rotate other stuff because Netflix just has the quantity of content that you need. Something new is coming out like every third day, whereas some of these other streaming services are maybe like once a month. And then looking at some of these valuations, I think these revenue growth, free cash flow, buyback assumptions are relatively predictable. Obviously, they're going to miss here and there in terms of where I have them, but this is a business that's somewhat predictable in terms of the price increases they're going to pass through, their margin profile, et cetera. It gets a bit more murky if they acquire WBD, but I think that's still long-term going to be good for them. Short-term might be somewhat negative in terms of margin pressures. But if you want to look at a 4% free cash flow yield, you get a fair value close to $70. That'd be a really good spot to buy Netflix at, in my mind. Even more conservative at 5%, you get a fair value of $56. I think if Netflix is trading at $56, something has gone wrong in the market. Trump has said something ridiculous or even more ridiculous than he's recently said. And we're in a recession of some sort. And at $56, I'd probably be buying quite a bit of Netflix because long term, that would be a good compounder for sure. And if you're a bit more optimistic about Netflix, a 3% free cash flow yield gets you to a fair value of $91. So in my mind, starting a position, holding a position, owning a position at $80, perfectly reasonable, probably gets you a 9 to 10% return with these assumptions. But I would want something a bit more. Like if you want a 15% return, for example, you get to the $65 range. I think I'd be a buyer of Netflix at $70. Don't own a position right now. I am considering a position, but I think and would hope that it drops a bit more in order for me to start one because I really love what they do. I'm not in love, but I get what they're doing with the WB acquisition, and I think long-term that'll work out, but short-term might give us some opportunities to buy at a lower price point. So maybe that's what I'm hoping for as a greedy conservative investor. So I like it at 80. Don't love it, would love it at 70 or below. So that's my take on Netflix. What do you think? Let me know down below. Comment, like, subscribe, and thanks for watching the video. Bye.